Good morning. Welcome to this update for global stocks and commodities for the 9th of April. What a strange week it was. We had several events during the week which really either of them could have caused very significant disruption to financial markets and in most occasions probably would. But markets remained very, very quiet and hardly had any response to them at all other than for just perhaps an hour or two. So I want to examine what those two vital events are because they really have the capacity to be absolute game changers for a long, long period of time. And I also want to examine a third aspect that I don't think the media is really doing justice to. So whilst it was a very quiet week on the markets, a little bit to talk about. So these are the two events that I think will shape markets for a long time to come. Firstly, the Fed signified that after 7 or 8 years of progressively buying debt of all sorts and inflating their balance sheet is what it's called, that they're talking about unwinding their balance sheet over a period of time. Now, at this stage, they're talking about it, but at least they've signaled that change in policy. Now, for the Fed to completely unwind their $4.5 trillion of debt that's on their books now, that would equate to something like 25% of GDP, just to give you an idea of the dimension of it. Now that is absolutely extraordinary, and if they attempted to do that over a short period of time, then obviously markets would be completely decimated. So there's no way that they're going to try and do this quickly, because what it would do is withdraw a massive amount of liquidity from the system, and it's certainly been liquidity which has helped the market in part get to where it is. The other part is it's been driven by earnings in the States, so there's been a genuine basis for the rally, but there's also been a huge amount of liquidity. It will also put upward pressure on interest rates. So as the Fed starts to wind down its balance sheet, then that will, all other things being equal, cause interest rates to move higher. So it gets down to how they do it. Have the time in which they do it and the degree of the changes. And that makes the impacts highly unpredictable. So we are heading into a period of, I think, even greater unpredictability than what we've seen in the past. Now, the second major event is the Trump tax and the reform of red tape. And until you really understand the way that the tax system works in America, not only for individuals, but for corporates, and also how they relate to the rest of the global financial community, you really can't appreciate just how massive the intended changes will be. There will be significant winners. In fact, if Trump can get most of what he wants in tax reform through, most sections of the stock market will be winners. There will be a few losers, but the potential impact on the US economy and their productivity and corporate profits is absolutely profound. I don't think I can overstate that. And it wasn't until I really understood the dimension of all that he's doing. The media is only mentioning one part of it, and that's the reduction in the corporate tax rate. But the reforms are so much more than that. I don't think the market is even remotely starting to think about pricing that in. Of course, the other event that occurred late in the week was the airstrikes on Syria. At this stage, the market reaction to it was almost nil, and so the thinking seems to be that this is a one-off event. And it may well prove to be a one-off event, but I don't think that's by any means guaranteed. This could be signalling a significant change in policy from the US in terms of their defense policy. It's been very soft under Obama. If Trump decides to follow through on this, then you could see a significant ramp up in tensions with the US. So that could also be a real game changer. But at the moment, the market is assuming that it's not. Now, given those events, it then begs the question, because the Trump tax reform is not going to become evident for quite some time. We may not see that until much later in the year. And we also have many other events that can unfold in the meantime. We've got the French elections coming up in May, which are absolutely critical. There's a whole lot of trigger points. So it's really a matter of how you should be positioning yourself now. So for me, it's a matter of trying to do two things. You obviously want to cover risk, and I think covering risk has never been more important. Because we've got so many unpredictable events that are now firmly on the radar. But you don't want to just go into your shell and become completely risk averse, because that doesn't get you anywhere. So you've got to leave yourself open to the profits, which are still very significant. And you've got to remember we've still got some exceedingly strong trends happening in America, particularly in technology. So my view would be that you should have some precious metals if Trump doesn't manage to succeed, or if he becomes overly aggressive on the international front. So I think there's a lot of reasons for the fear trade to come back and for gold to be a beneficiary of that. So therefore, I think you should own some precious metals or precious metal stocks. The second part would be to stay with sectors which have relatively insulated drivers. In other words, what are the sectors where the drivers are just so strong and so independent of Fed policy, of Trump, international global stance, the possibility of Trump getting his reforms through? What are the sectors that are really going to carry on pretty much regardless? And therefore, any short-term reaction in the market is going to be just that. It's going to be quite short-term, and then the trends will resume. And I've been progressively outlining what they are, and of course, members know very, very clearly what those sectors are. Just a perspective on gold before I move on to the markets. To my way of thinking, I don't really, I don't really seek to make massive gains from precious metals, because it is a manipulated market. It's it's hard to really follow with a very, very substantial amount of your portfolio. But to me, it's an essential part because it's a hedge against government stupidity and experimentation. And we've just seen over the last decade and a half, we've seen the greatest financial experimentation ever known to man, and no one knows how that is all going to unwind and play out. It's also a hedge against government corruption, and I put that in inverted commas because I don't mean to infer that there is overt corruption in the normal sense, but really corruption in terms of favouring the elite, the policies that have led to a huge disparity between the wealthy and the rest of society. So it's that sort of government corruption that I'm talking about. So just to repeat again, I think it's important to have some exposure to precious metals and precious metal stocks, even if in the short term sometimes you get beaten around the ears a little bit. But it should not be the majority of your portfolio, that's for sure. So let's turn to American stocks now. The S&P was lower by 8 points on the week, and it's behaving, pretty much exactly as I've talked about over the last couple of weeks. It's hard to see what's going to drive the market down very much, but equally it's hard to see what's going to drive it up very much until we see some more substance from Trump policy. The market breadth is still holding up pretty well, so that's encouraging. If you look at the Russell 2000, we'll take a look at that in a minute. The small caps aren't really being sold off, so that's encouraging. So I can only conclude that we should expect the current quite tight trading range to continue for a few more weeks. The market had become overbought. That overbought level can unwind in one of two ways. The market can either correct 5, 10, perhaps 15%, or it can just go sideways and basically let the fundamentals of the market and the technicals of the market catch up. And that's really what's happening at the moment. So let's take a look at the S&P first of all. So there's the daily chart, and you can see we're in this very tight range. This green rectangular box here has been the area that I was looking for the market to pull back to. And you can see that it stayed after a little bit of an initial bouncing around, it's really stayed right smack in the middle of that box, right on the 50-day moving average. We've retraced to almost the 50% level of the very short-term range, but we haven't even got close to the 38.2% level of the bigger range. So there's a capacity, if something disturbs the market, that we could see a sudden downdraft to 2280, but at the moment it's certainly not looking like it, that's for sure. Turning now to the Russell, there's the Russell 2000, and you can see it's also really doing the same thing. It's not quite as strong as the S&P, but it certainly is holding up quite nicely. Now the US dollar did find some strength with the Syrian airstrikes. It was already on the rebound. And again, we've just got another range here. So between 99 and 102 is the current range for the US dollar. And unless markets get really spooked by something, I would expect the US dollar to stay within that range also. Let's look at the Australian dollar. So if we pan back, you can see we've been in a bigger range, which was between 71 and 78, and that range really started to form about a year ago. And of late, we've formed into an even tighter range between 75 and 77.5. And so you can see we've been locked in that range for some time. Now, eventually, of course, the Australian dollar will move out of this range. The fundamentals would dictate that it go lower, but it's a very strange world we're in these days, so I wouldn't want to hang my hat on that in the short term. Just looking at the Australian ASX 200, we had a range between 5,600 and 5,800. We eventually broke above that. Haven't made it to 6,000 points yet, but consolidating around the 5850 mark. So it's likely that we've still got a little bit more yet to push up to that 6,000 level. But it's going to be difficult because certainly the regulators in Australia are making noises about requiring the banks to increase their Tier 1 capital, which will mean that's going to put pressure on the share price. It's certainly not going to be helpful, that's for sure. So the Aussie dollar at 75, our index hardly changed for the week, and 5,800, which had been a resistance level, is now offering some support. But again, as I've been commenting now for some time, there's very little that's actually trending in Australia. It's really just not happening for most stocks. Now turning to precious metals, surprisingly subdued given what was going on. Gold rose $5 to $12.55. It did get up to $12.73 on Friday after the US airstrikes, but came off fairly quickly when the market concluded that this was probably a one-off event. Now, the Syrian airstrikes, I think, are potentially a real game changer because it could be signalling a change of the relationship with Russia to one of a higher tension level. So I think in the medium term, the odds have swung again in favour of gold because certainly gold doesn't mind having some international disruption. Short term, how it plays out depends very much on how the market views it. At the moment, the market is viewing it as a one-off event, the Syrian airstrike, but you'd have to acknowledge that there's a very good chance that there will be follow-up consequences to what's happened. Now, the interesting thing is that futures speculators really loaded up on precious metals in the futures market. Now, this is the Commitment of Traders report, which cut off on Tuesday last week. So this is not up until Friday and doesn't include what happened with the US airstrikes in Syria. So futures speculators had already been loading up on precious metals. So that's created some excess. Now, we're still well below the 2016 peak. At the moment, the gold futures market is net long around 200,000 contracts. We saw a peak in 2016 of around 270, 280,000 contracts. So we're not remotely at that excess level, but it's still built up quite a bit in the last few weeks. So just be aware of the lag in the data there. But interestingly, gold really hasn't moved in the ETF market. So it's all been in the speculative futures market at this stage. The holdings in GLD stayed rock steady at about 836. Silver, however, in the futures market, the net speculative position has returned to all-time highs. So silver is quite extended, and silver has been outperforming gold throughout, which you often see not right at the start of a new bull market in precious metals, but certainly once the bull market starts to get going, then silver does start to outperform. So there's a bit of a positive there. So let's just look at the silver and gold market. There's silver. You can see we're trading up around levels that were formed in November. So we had peaks in November and February, came off on Friday night, so that's probably a bit of that excess unwinding in the futures market, but still doing reasonably well. If you look at gold, was in fact slightly higher on the night on Friday, but you can see we had a bit of a spike in the gold price, but it did finish basically back where it started from. So the market kind of shrugging its shoulders over the geopolitical events. And we'll just take a look at gold on a weekly basis. So we remain basically at the same level that we were at in about 14 months ago in February of 2016. So this bull market is really taking its time to really get going. Just check in on the gold stock indices. This is GDX. Stocks opened very bullishly, but basically gave up nearly all their gains by the close, and we're still in this range with GDX, albeit towards the upper end of that range. Turning now to other commodities, copper was pretty much unchanged. Crude oil spiked back up as you would expect with airstrikes in the Middle East, back up to 52. But I'm still not convinced that we won't see oil back down in the mid 40s yet. Hasn't really washed out as much as I would like. So I think the only way to engage in the energy market is to really wait for a decent dip in the share prices of those energy stocks. To do anything other than that is really not overly smart, I don't think. It's a spot copper chart, not much change there. So to wrap it up, in terms of current positioning, markets are in a range. So what should you do? Look, buying a dip to oversold is all that makes sense. Trying to put your money into the market just for the sake of having it in there doesn't seem to have much point to me, because there's not a lot of short-term potential upside. There's always the potential, if someone fires off some rockets somewhere, that the market could take fright at that. So therefore, I think you should reserve your cash and only buy significant dips to oversold. It requires patience. It requires focus to know what you want, what price you want to pay. So, get your shopping list together. Be very clear about what you want to buy and what price is acceptable to you, and then just have the patience and let the market come to you. And for goodness sake, don't fall into the trap of deciding that you want to buy a particular stock. You should never approach the market like that, because it does cause you to tend to want to just find a way to buy that stock. Your attitude should be have a big shopping list, have attractive prices, and only accept what comes to you on your terms. Now, the Trump policy success, if he can get anything through, will be a huge driver for the next 5 years and beyond, not only for America, but also for the rest of the world. If Trump can get it through, it'll see a terrific impact on US economy and stocks. You'll see stocks surge a long way. So I really can't overstate the potential benefit. It's hard to imagine Trump not getting most of his tax policy through. Now, stranger things have happened, but frankly, there is so much advantage for everybody, not only the whole community from personal tax, from corporate tax. It's going to be very hard for the Democrats to oppose a lot of what Trump wants to achieve. I mean, how are they going to go back to their constituents and say that we voted down the opportunity to reduce corporate and private tax? And it's going to be hard for the dissenters in the Republican Party to do the same. They're going to find it very difficult to justify to their electorates. So I believe it's a matter of time before Trump gets his tax reforms through, and the impacts in 2018 and beyond will be very, very substantial, and they are not priced into the market at this point in time. So I think there are a lot more positives than what the market is acknowledging, and I'm keenly watching how things unfold in Washington. So that's it for this week. There's my contact details for anyone who's not a member who wants to get in touch with me, and I'm sure we'll have another fascinating week ahead of us. That's it. Cheers.